And the assignment for round 4. Now don't be concerned. It looks like an awful lot of text, and it is. The questions aren't nearly as complicated as what all the text looks like, so be patient, read through them, listen to this, and sort out just those few items that you actually need to answer some of these, especially the first 2 longer questions. So question 1, Digby's investment in TQM, if you remember right, they invested a bunch, will at a minimum increase demand for its products. If you saw 7.69% in this, in the 4th round, but in all future rounds. Looking at the round 4 Courier for Digby, last year's sales were about $220 million, almost $221. Assuming similar sales next year, the 7.69% increase in demand will provide an extra almost $17 million of additional revenue. This should say, assuming similar demand next year, maybe. I've already posted this. Won't make too much of a difference, but okay. With the overall contribution margin of 33.8, that's what theirs was. After direct costs, this revenue will add $5,738,765 to the bottom line. That's not counting taxes and whatnot. But for simplicity, assume that the demand increase and margins will remain at last year's level. Okay, so not really saying much there. It's just telling you that the numbers that I gave you above are the numbers to use. How long will it take to achieve a payback on the initial $20 million TQM investment, rounded to the nearest month? Ignore other savings achieved through TQM and the tax consequences or benefits. So really all you're doing here, okay, is I've calculated everything for you, what the increase is going to be to the bottom line. Actually, it's kind of before tax dollars, but good enough. And I want you to then tell me what the payback is going to be when we invested $20 million. So that number and that number are the only 2 numbers that you really need in order to do this correctly. Okay. Keep in mind you'll probably get a decimal, and you might need to convert that to months. And keep in mind that there's 12 months in a year. Okay, so there's number 1. Number 2, in order to sell a product at a profit, the product must be priced higher than the total of what it cost you to build the unit, plus period expenses and overhead. At the end of last year, product Ebb was sold by Erie. Use the Courier's production analysis to find Ebb's production cost, so it's labor plus material cost. Those are given to you right on a per item basis, and ignore possible inventory carrying costs. And then let's assume that the period expenses and overhead equal 1/2 of the production cost, meaning that if the production cost, let's say the total of labor plus materials was $10, and the period expenses and overhead combined would be $5 then, so a total of $15, right? So what's the minimum price the product could have been sold for to cover the unit cost, period expenses, and overhead? Okay, so again, this is period expenses and overhead combined, total 1/2 of the production cost. So 3, how much in after-tax profit did Andrews leave on the table in the high end? The term I like to use, I guess, leaving money on the table, meaning you didn't take it with you, but show missed unit sales, missed revenue, missed profit before tax, and missed profit after tax. Again, this is something that we've done before, right? And in this case, however, you've got 2 separate products, okay? And so be concerned about both of those products, and let's go take a look, and I kind of showed this when I was doing a review of the round, but you've got the 2 separate products. I'm talking about Andrews, aren't I? Yep. You've got, is it Adam here, that had a potential of 18.8, and then 17 was its actual, and Ace then with potential of 23.3 and 6.4. So you're going to have to break it down by each product, actually, in order to arrive at a final number. Okay, or final numbers. If you left them both separate in terms of your calculations, that would be fine, but they probably have differing sales prices. They may or may not have different sales prices, but probably for sure they have different variable costs. Okay, and so you have to calculate those in, okay, to calculate their contribution then towards the bottom line, and then of course you'll have to take out the taxes. And taxes, I think I've showed you in the past how to calculate those. You can either, I think, look it up in the guide. It might say someplace, or just go to the income statement and take a look at like any team you could use, but probably easier if you use one that made a profit. Okay, and just calculate what their tax percent is. It's the same for all the teams. 4, assume Team Chester bought back 200,000 shares of stock last year. That's round 4. Okay. Last year, round 4. Okay, the purchase price would have been the market price of the stock at the beginning of the year. Had the purchase not affected interest or profit, what would the effect have been on, and show the math, both the earnings per share and the ROE? So, again, I've said oftentimes, when we talk about buying back stock or paying dividends, we take that right out of equity. Okay, and in this case, our share numbers are going to decrease, right? So that's going to have a direct effect on earnings per share, but our equity numbers also going to decrease because we're spending that money to buy back stock. Okay, so you got to calculate or go back and look. The price at the end of round 3 should be equal to the price at the beginning of round 4, but you can calculate that also based on the gain experienced in round 4 minus what the closing price was for round 4. Okay, either way would get you there, and then you just have to do the calculations like we've done in the past. If you need some help there, go back and look at the past assignments. I think just last week we did one on ROE. So there you have it, a preview for your 4C assignment.